Hi everyone, welcome to today's webinar with me, Fawad Razaqzada, market analyst with Think Markets. Today's webinar is going to be conducted by myself only. My colleague Victor, who normally joins us in these webinars, is still on holiday, so he will be back next week, and I'll look forward to having him back in this webinar. Now, obviously, this webinar is live, so thank you so much for those of you who have joined us live. Please don't hesitate to ask us questions during this webinar, as we would like to keep things as interactive as possible. For those of you who are watching a recording of this, please make sure to join us live next time. So before we begin the webinar, as always, please have a quick read through the risk warning. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So obviously this webinar is happening every Tuesday, 11:30 London time. We talk mainly on technical analysis on live charts. We cover the major FX pairs, gold indices, and cryptocurrencies as well. In terms of fundamental analysis, we keep it brief in most cases, but it's worth mentioning, the fundamental analysis aspect of in terms of how it's impacting the markets at the moment. And after Friday's, big US jobs report beat, the focus is shifting back to inflation with this week's upcoming data releases, as investors continue to speculate about the timing of the Fed's decision to taper its bond purchases. It looks like investors are starting to believe that we are getting very close to that time, and Fed Chair Jay Powell may very well provide the roadmap for tapering, either at the Jackson Hole Symposium or at the FOMC's September meeting. Now, we've heard from several Fed officials, including Chairman Richard Clarida and James Bullard, who have indicated that an announcement to start reducing the asset buying program may be appropriate soon, effective later this year or early next year. And if you look at the incoming macro data in recent times, they have kind of supported the hawkish view. There was nothing not to like about the Friday's non-farm payrolls report, which came in really strong, with the headline jobs number coming in at just shy of 1 million, and there was a favorable revision to the previous month's figure, while average earnings rose strongly. This week, the focus, as I said, is going to shift to inflation again. And if I show you the economic calendar, let me just get rid of the non-important stuff. So yeah, immediately you can see that the main data release for this week is Wednesday's publication of US CPI. This is going to be obviously really important, and we already know that inflation has been quite high in recent time, and this inflation report is expected to show a slight moderation. Now, this economic calendar doesn't have the year-over-year readings, but I'll tell you what they are expected anyway. So inflation is expected to ease to 5.3% from 5.4% previously, with core CPI expected to drop to 4.3% from 4.3% from 4.5% previously. In terms of month over month, you can see that inflation is expected to come in at 0.5 and 0.4% respectively. Obviously, if the numbers are strong, then that will be positive for the dollar, you'd expect. Whereas if they're a little bit weaker, then we may see the dollar come down a little bit from its high levels. We'll have more inflation estimates or gauges, I should say, later on in the week. In so far as the US is concerned, we have the producer price index and core PPI on Thursday, and on Friday we have the University of Michigan's inflation expectations reading. This is going to be important going forward because of the high prices, and people are going to expect prices to remain high. And if that kind of gets embedded into people's expectations, then that will actually it will lead to actual inflation. So that's something that the Fed is going to be monitoring very closely. And if you see inflation expectations climb higher in recent in the next couple of months, then that would encourage the Fed to start tapering sooner than expected. And as you can see, the trend has been rising in terms of the inflation expectations. I can see a couple of questions or a comment here. You have somebody talking in the background. I'm really sorry. Yeah, I'm sitting in the office at the moment, and people, it's quite loud here. So I do apologize if you cannot hear me clearly. But for those of you, if you can't hear me, then please let me know. But yeah, I do apologize about the background noise. I can't do anything about it, I'm afraid. But if you can't hear me, let me know so that I can change a few settings on the mic. Let's move on and talk about the markets now. So in terms of the reaction of inflation to in terms of the market's reaction to the upcoming inflation data this week. So obviously it all depends on how the number is going to come out. If inflation is it comes in stronger than expected, we may see the stock market rally come under a bit of pressure, or at least we may see like a muted response. So far, the stock markets haven't really responded in the way the dollar has. So you can see the dollar has been going up, but the stock markets have also been going up, dismissing concerns about inflation. This is the S&P 500 chart. So as you can see, the S&P is sitting at all-time highs, not showing any concerns about tapering the same way gold and silver have. And we've seen the dollar go up as well because of strength in US data. But so far, the S&P 500 and the US stock markets in general, they have been able to shrug off concerns about inflation. Could that change? Well, it depends on how strong the CPI number will be on Wednesday. If it's really strong, then we may well see the S&P 500 come down as it tests the 127.2% Fibonacci extension level of its most recent downswing. So it's at an area where you'd expect it to come under a bit of profit-taking pressure, which may already have started. And if you look at the bodies of the candles over the last couple of days, it's telling you that the market is really not sure where it wants to head. People are just waiting to see the outcome of that inflation report. Now, if the CPI comes out weaker than expected, then that will keep the Goldilocks scenario intact for the stock markets, and we may very well see renewed strength in the in this bullish trend and continue higher from here. All told, the trend is still very strong and will remain that way until and unless we get a breakdown in the market structure of higher highs and higher lows. So the most recent or significant low comes in at this level, and that will be the line in the sand for me. So let's call that invalidation level, right? So if the market were to drop below that level, then we will have created our first lower low. In terms of shorter term invalidation levels, you can see that there's a bit of a support building around here at 43.72. So that could be our first first invalidation, short-term invalidation level. So if that level breaks, then we may see a drop to retest this bullish trend line. Now let me zoom out a bit. You can see the trend line has been in place since March. It has already been tested a couple of times. I wouldn't be surprised if the market were to come down and test it one more time, in the event inflation comes in stronger than expected. What do I mean by Goldilocks scenario? So Goldilocks scenario is a term people use, have been using for the stock markets during the melt up, because it's a scenario where the markets are supported both by the Fed keeping its policy loose, yeah, and at the same time we've been seeing improvement in data. So it's been supported on both fronts. A loose monetary policy stance from the Federal Reserve and improving economic data. So the improvement in data has not been so significant to cause concerns about tapering or reduction of monetary stimulus. Therefore, if CPI were to come in a little bit weaker, or perhaps in line with expectations, this will keep the so-called Goldilocks scenario intact, because the Fed is already expecting inflation to be a little bit higher, right? And so a little bit of weakness in inflation will be a welcome relief for the markets and for the Fed, meaning that they will not be in a rush to taper bond purchases. Now, in jobs report on Friday came out really strong. That is something that was kind of met with mixed reaction, really. The markets did rise a little bit, but not too much, because although the jobs report was really good, it increased the probability of the Fed tapering its bond purchases. So had the jobs report been a little bit weaker than we saw on Friday, we will have seen a stronger response in the stock markets, because of expectations that the economy is improving, jobs are rising, but not so fast to encourage the Fed to taper its bond purchases. So yeah, overall, it's still Goldilocks scenario, but if we start to see an acceleration in the jobs growth or in inflation, then that would end that trend. I hope that that has answered your question. Now, stock markets in the US are trading at all-time highs or near all-time highs. In Europe too, if you look at the Europe Stocks 600, this is an index consisting of stocks, of the top 600 stocks in Europe, including the UK, in terms of market capitalization. This is the weekly chart. And you can see it's been going up and up and up. I think it's at a record high. So sentiment towards European stock markets are likewise improving, or have been improving. And this is all to do with the fact that the European Central Bank is doing what the Fed was doing previously, which was to remain super dovish in spite of vaccinations program picking up and data improving. So if you look at the German DAX index, we are very close to a previous all-time high. Previously, I circled this inverted hammer candle because there was no downside follow through. Yeah, we went below the low of that candle, but the fact that there was no downside follow through, it strongly suggested to me that it wanted to go higher. Lo and behold, it did, and took out the high of that candle. Now that it's kind of hesitating just ahead of the previous all-time high, it looks very likely, in my view, that it will break higher from here. So if you're struggling to find trade ideas, I would strongly recommend taking a closer look at the European stock indices, because they have been trending. So this, obviously the German DAX hasn't been trending per se because it's been in consolidation, but some of the other European indices have already been going up. For example, the French CAC index. And if you look at the Euro Stocks 50, this has also been going up. Another index that you may want to look for potential trade ideas is the Spanish Ibex index. Obviously, in Spain, things have not been as good as some of the other parts of the Eurozone, because obviously Spain relies heavily on tourism, but the Delta variant of COVID meant that travel and tourism was not going to be as strong this summer holiday as people had hoped, and that's why the Spanish index has been underperforming. So this was the pre-lockdown high, and we've created a lower high beneath that. Nevertheless, the Ibex has broken resistance at 88.35 or 30, this blue level right here. So the fact that it's broken above it, it means that the path of least resistance is likely to be to the upside still. So if we see a retest of this 88.33 level or 35 level, we may well see a bounce from there ahead of more gains. But obviously this is not as strong as the DAX, so treat it with a bit of caution if you do look for long trades on this market. Let's move on and talk about some currency pairs now. You know, I mentioned the Fed becoming hawkish. Several Fed speakers have already you know, kind of prepare the markets for the Fed to announce its tapering plans. The dollar index has consequently been printing bullish price action, and it's now broken above the bearish trend line. Yeah, and it's getting very close to its high that was hit last month at 93.19. Now, most of the strength in the dollar index is coming from weakness in the euro, because the European Central Bank, as I mentioned, is quite dovish compared to almost all other major central banks, and traders have been selling the euro across the board, not just against the dollar, but against the pound, against the yen, you name it. So against the dollar, the euro dollar is looking quite weak, isn't it? It has already broken below this bullish trend line. It's residing below its 21-day exponential and the 200-day simple moving average. Price is creating lower lows and lower highs and so on. So you get the picture. There's a lot of selling pressure coming on the euro dollar. And so as things stand, it looks very likely, in my view, that the March low at around 117.05 will be retested, and we're very close to that level now. So watch out for a potential test of that level. Now, what happens thereafter is dependent on the reaction of price when speaking from a purely technical point of view. So if we get a clean break and price stays below, then any rounded retest could be sold, and that could then lead to renewed downward pressure towards 115. So that would be the ideal bearish scenario. Alternatively, what might happen is we might get a break down below 117, and then a quick recovery, yeah, and price then goes back up to close above this red level at 17.15, leaving behind a candle that would look something like this, which would be considered bullish, right? Let me just color that in white. So if you get a candle like that, it would be considered a bullish outcome, because price would have created a false break below this low. So in that case, if we see that, then that would be bullish, at least in the short-term outlook. and it could then lead to a possible move up to 1830, this level right here, which was the base of the recent breakdown. Potentially ahead of more gains in the future, but we'll cross that bridge if and when we get there. So for now, the key level to watch is this 1700 level. The key question is, what will happen if and when we test that level? Do we go below and stay below, or do we get a quick rejection rather, and a move back above? Okay, so those are the two potential scenarios that we will be concentrating on. I can see Hassan, you're asking about gold. Let's have a look at gold very quickly. Actually, before we move on to gold, let's just finish this the currency markets, and then we'll move on to gold. So the euro dollar is showing strength for the euro, for the dollar rather. So is the dollar yen. The dollar yen has been going sideways for the most part of the summer, but in more recent days it has been climbing higher, and this is all to do with speculation about timing of the speculation over the bond purchase being tapered in due course, leading to a strength for the dollar. The Japanese yen is a safe haven currency, and with the stock markets hitting all-time highs, there is not much demand for the Japanese yen at the moment, but that could change, obviously. In terms of the cable, well, the pound has been one of the more stronger currencies, and it hasn't really sold off significantly against the US dollar at the moment, which means therefore that if you want to take out the dollar out of the equation and concentrate on a currency cross, then the euro pound makes sense to look for shorting opportunities or to look for further breakdown. And as you can see from this daily chart, price has been creating lower lows and lower highs after a lengthy period of consolidation here. So this breakdown is going to, well, it is leading to fresh strength on a relative basis for the pound and weakness for the euro. Going forward, this is the key resistance area that needs to be defended by the sellers. As I draw a box around it. So the way I would go about this is I'd favor looking to sell the potential rallies back into the resistance area for a potential move down to 84 initially, ahead of 83 over time. Why those two levels? Well, 83 was previously a key support in the past, as you can see by the reactions of these price spikes. In terms of 84.07, well, that level is the base of this breakout that happened in February, right? So those are the next downside targets for the euro pound. Okay, let's look at gold now. Gold has been it has been struggling, obviously. The reason for gold's struggle is threefold. First, stock markets have been rising, so there's less demand for safe haven assets like gold, silver, and Japanese yen. Secondly, the dollar has been rallying. Gold is priced in the US dollar, as are most other commodities, right? So when the dollar goes up, gold tends to go down. Thirdly, the jobs report on Friday boosted bond yields. In the US, the 10-year yield rose on Friday, and it has extended its gains a little bit at the start of this week to create a interim higher high. So when yields rise, this increases the opportunity cost of holding gold. So for all those three reasons, gold prices slumped, and there was a bit of a flash crash on Monday when the market, the market had closed really weak on Friday in response to the US jobs report, right at the lows. So when the markets opened on Monday, there was lots of stops resting below the low of that candle and this low here. And those stops were triggered, leading to a sharp sell-off, which was then bought later on in the day, leading to a close well off the lows. But it still closed the day in the red, suggesting that the short-term bias remains to the downside. Now, going forward, where do I see gold heading to? I think most of the bearish factors impacting the price of gold has now been priced in. In particular, the Fed's dovish, the Fed turning hawkish in recent times. I think that has been priced in. So what I would be looking for next is, look at bond yields across the board, not just the US. This was the US, by the way. Look at the German yields and see whether this downward trend in yields will remain in place or whether we'll see a strong recovery. For as long as yields across the world continue to remain under pressure because of rising Delta cases or because of weakness in data or whatnot, then that should provide some support for gold. Yeah. So keep an eye on yields. That's the main thing. Secondly, we may see stock markets come under a bit of pressure because of valuation concerns and whatnot. That could then lead to safe haven flows into gold and silver. But from a purely technical point of view, it needs to create a key reversal sign for me to turn positive on gold. So far, it is holding support, long-term support between 1680 to 1700. Let me show you on the weekly chart why that level is important. I'm just cleaning up the chart a little bit. Okay, so this is the weekly chart of gold. This is the high gold had reached before the pandemic hit, and gold sold off before recovering strongly to hit an all-time high. So this level is really important at 1703. Zooming out a little bit further, you can see that despite gold looking really weak and struggling, it has only given back a relatively small portion of its gains. So if I draw my Fibonacci's from the low to the high on the weekly chart, you can see gold has continually found support around the relatively shallow 38.2% Fibonacci retracement level instead of a deeper retracement like 61.8. So on a relative basis, when you look at it from a long-term point of view, gold had been inside this consolidation for like 6 years or something, right? So when it broke out of this in 2019, that led to a sharp rally to a new record high. So since that breakout, it has been, since hitting a new all-time high, it has been consolidating. Yes, it's been going down, but in the grand scheme of things, you can call this a consolidation rather than a sell-off. Obviously, on the daily chart, it looks a lot more bearish than it does on the weekly, but when you talk about the longer-term price action, this is merely a consolidation in my view. So the fact that the 38.2 is holding a support, as well as the what do you call it, the pre-pandemic high at 1700, that is positive. What we need to see next is a breakout of some sort from the consolidation pattern. So if you draw your trend lines, you can see that it's been bouncing inside this triangle pattern. So on this weekly time frame, what I'm looking for is an eventual break above the resistance trend of the triangle pattern to tip the balance back in the bull's favor. That could be a long wait, by the way, but if and when that happens, then that is when I would be looking at gold from a bullish point of view. Once again, until that happens, there's a risk, obviously, that the support can give way, leading to a sharper drop, or we could see continued consolidation for a long time. Which means, therefore, that if you are trading gold in the short term, just take it from one level to the next and move on, because this is not a trending market to be holding gold for long periods of time. On the daily time frame, what I would be looking for is a move above Monday's candle at 1765, because that level is going to be resistance, or the upper end of resistance of this. You see, this area was previously support, resistance, support, support, support. We broke below it. So on the daily time frame, if gold were to go above this shaded region between 1750 to 1765, then that would be a bullish outcome. Otherwise, it's very difficult to be bullish gold at these levels. So it needs to move back above that zone in order to turn the short-term outlook back to being bullish. So if that level were to give, or that area were to give way, then gold could, at the very least, rise to retest the bearish trend line and this next area of resistance between 1790 to 1800. On the downside, we already mentioned the pre-pandemic high at 1703. If we close below this support zone between the pre-pandemic high and 1680, that would be considered a bearish development, because this level has continually provided support in the past. Therefore, a break below it would be quite bearish from a technical point of view. That's not to say that we will hold below that breakout, because what could happen is we may see a brief break and a quick recovery, leading to a false break reversal pattern there. So that could be another scenario to look out for. But where it is right now, it's really trading in no man's land. And so I really don't have any strong views on gold at these levels. Let's have a look at a few other markets, shall we? Crude oil is making lower lows and lower highs because of concerns about demand for oil. The surging virus cases in the US and elsewhere now, in Asia, and the lockdowns in Australia and elsewhere have hurt demand, the demand outlook for oil. And this comes at a time when the OPEC is slowly releasing more and more oil back to the market. So previous expectations that the oil market will be tightened this year, those expectations are not as strong as was the case previously, which is why oil prices have gone down. Keep an eye on oil inventories in the US, and we have on Wednesday at 3:30 p.m. London time crude oil inventories coming in from the US. Last week, we saw a surprise build, which is an indication that demand is weak. Previously, you can see there were more drawdowns in oil inventories than builds. But if we start to see more builds in stockpiles, then this will increase worries about the lack of demand, leading to potential weakness for oil prices. Guys, if you have any further questions, please ask now. Otherwise, we have run out of time. I think there's time for one more question. So if you have one more question, then please ask it now. Otherwise, we'll end the webinar. Oh, I can see one more from HH Hassan. How do you analyze futures charts? You mean stock index futures or crude oil futures? The same way as you would a normal market, really. There is no difference insofar as technical analysis is concerned, if that's what you mean, on futures charts or the cash market. So, for example, if you look at the cash gold and gold futures, which I don't have here. So this is the cash gold. It's very similar, as you can see. This level is slightly different to the cash market, but essentially prices move in the same direction. HH Hassan asked that they do not give charts for longer periods for futures. Well, that's true, because futures charts are usually like 3 months, but you need to look at the so-called continuation charts for futures. Okay, so this one right here is the continuations of the front month gold futures contract. So this will go back in time, like the cash gold does. Another question, could I access old webinars recording somewhere? Of course you can. The place to access the webinars is YouTube for now. Go to YouTube, go to Think Markets. We have playlists. In the playlist, you can see the previous webinars in this particular playlist. Think Markets Live Market Analysis. Click on the full view playlist, and you can see all the previous webinars right here. Okay. Also, speaking about YouTube, we provide lots of educational videos here. I personally have been creating a series on key reversal patterns and trading the failure of those key reversal patterns. There's lots to learn from them. So if you click on the full playlist, you can see there are 4 videos on the key reversal pattern series. And in the trading the failure of those key reversal patterns, there are 7 videos. There's lots of really important information in these videos. They're not very long, each of them being between 5 to 8 or 9 minutes. So watch them, and I hope that you guys will learn something from these videos. I am planning to make more videos for Think Markets. I think the next topic is going to be on continuation patterns. So watch out for that. I will be producing videos similar length in a similar format, but in a different playlist. And for those of you who are wondering how to join the webinar, go to our website. If you're watching a recording of this, go to our website, Think Markets, Market Analysis, Live Webinars, and then here you will have a list of upcoming webinars which you could register for. Okay. I can't see any further questions, so thank you so much for joining me, and I hope to be with you guys same time next week. And yeah, be careful. We have, as I mentioned, important data coming out from the US in terms of CPI that could cause some volatility. But otherwise, the economic calendar is quite quiet this week, which is not very surprising given that we are in the summer months. Anyway, I'll speak to you guys next Tuesday. Take care. Bye-bye.